Critical Man Pictures presents the Forex video training series, Black Belt Course Second Degree, Intermarket Correlations. Before we detail the relationship between commodity dollars and gold, let's first note that the US dollar and gold don't quite mesh very well. Usually, when the dollar moves up, the gold falls and vice versa. The traditional logic here is that during times of economic unrest, investors tend to dump the greenbacks in favor of gold. Unlike other assets, gold maintains its intrinsic value, or rather, its natural shine. Nowadays, the inverse relationship between the greenback and gold still remains, although the dynamics behind it have somewhat changed. Because of the dollar's safe haven appeal, whenever there is economic trouble in the U.S. or across the globe, investors more often than not run back to the greenback. The reverse happens when there are signs of growth. Take a look at this chart. Currently, Australia is the third biggest gold deal, we mean gold producer in the world, sailing out about $5 billion worth of the yellow treasure every year. Historically, the Aussie-US dollar has a whopping 80% correlation to the price of gold. Still not convinced? Here's another one. Across the seven seas, Switzerland's currency, the Swiss franc, also has a strong link with gold. Using the dollar as base currency, the dollar Swissy usually climbs when the price of gold slides. Conversely, the pair dips when the price of gold goes up. Unlike the Australian dollar, the reason why the Swiss franc moves along with gold is because more than 25% of Switzerland's money is backed by gold reserves. Isn't that fucking awesome? The relationship between gold and major currencies is just one of the many we will tackle. Now, let me talk about the other kind of gold, the black one. As you may know, crude oil is often referred to as black gold. One can live without gold, but if you're a crack addict, you can't live without crack. Oil is the drug that runs through the veins of the global economy, as it is a major source of energy. Canada, one of the top oil producers in the world, exports around 2 million barrels of oil a day to the United States. This makes it the largest supplier of oil to the U.S. This means that Canada is the United States' main black crack dealer. Because of the volume involved, it creates a huge amount of demand for Canadian dollars. Whenever oil prices rise, it normally leads to some decline in the U.S. versus CAD. Also, take note that Canada's economy is dependent on exports, with about 85% of its exports going to its big brother down south, the U.S. Because of this, the dollar CAD can be greatly affected by how U.S. consumers react to changes in oil prices. If U.S. demand rises, manufacturers will need to order more oil to keep up with demand. This can lead to a rise in oil prices, which might lead to a fall in the U.S. dollar, Canadian dollar. If U.S. demand falls, manufacturers may decide to chill out since they don't need to make more goods. Demand in oil might fall, which could hurt demand for the CAD. So the next time you gas up your car and see oil prices are rising, you can use this information to your advantage. It may be a clue for you to go short on the US dollar, Canadian dollar pair. Some Forex brokers allow you to trade gold, oil, and other commodities. There you can readily pull up their charts using the platforms. There are several other sites that you can monitor the prices of gold at timingcharts.com and kitco.com. A bond is an IOU issued by an entity when it needs to borrow money. These entities, such as governments, municipalities, or multinational companies, need a lot of funds in order to operate, so they often need to borrow from banks or individuals like you. When you own a government bond, in effect, the government has borrowed money from you. You might be wondering, isn't that the same as owning stock? One major difference is that bonds typically have a defined term to maturity, wherein the owner gets paid back the money he loaned, known as the principal, at a predetermined set date. Also, when an investor purchases a bond from a company, he gets paid at a specific rate of return, also known as the bond yield, at certain time intervals. These periodic interest payments are commonly known as coupon payments. Bond yields refer to the rate of return investor paid to the bondholder, where the bond price is the amount of money the bondholder pays for the bond. Now, bond prices and bond yields are inversely correlated. When bond prices rise, bond yields fall and vice versa. Here's a simple illustration to help you remember. Wait a minute, what does this have to do with the currency market? Always keep in mind that intermarket relationships govern currency price action. In this case, bond yields actually serve as an excellent indicator of strength of the stock market. In particular, U.S. bond yields gauge the performance of U.S. stock market, thereby reflecting the demand for the U.S. dollar. Let's take a look at one scenario. Demand for bonds usually increases when investors are concerned about the safety of their stock investments. This flight to safety drives bond prices higher and, by virtue of their inverse relationship, pushes bond yields down. As more and more investors move away from stocks and other high-risk investments, increased demand for less risky instruments, such as U.S. bonds and the safe haven U.S. dollar, pushes their prices higher. Another reason to be aware of government bond yields is that they act as an indicator for the overall direction of the country's interest rates and expectations. For example, in the U.S., you would focus on the 10-year Treasury note. A rising yield is dollar bullish. A falling yield is dollar bearish. It's important to know the underlying dynamic of why a bond's yield is rising or falling. It can be based on interest rate expectations, or it can be based on market uncertainty and a flight to safety to less risky bonds. After understanding how rising bond yields affect a nation's currency to appreciate, you're probably itching to find out how this can be applied to forex trading. Patience, young Padawan. Recall that one of our goals in currency trading, aside from catching plenty of pips, is to pair up strong currency with a weak one by first comparing their respective economies. How can we use this to their bonds to do that? The bond spread represents the difference between two countries' bond yields. These differences give rise to carry trade, which we discussed in a previous lesson. By monitoring bond spreads and expectations for interest rate changes, you'll have an idea where currency pairs are headed. Here's what we mean. As the bond spread between two economies widens, the currency of the country with a higher bond yield appreciates against the currency of the country with a lower bond yield. You can observe this phenomenon by looking at the graph of the Australian dollar-US dollar price action and the bond spread between Australian and US 10-year government bonds from 2000 to 2009. Notice that when the bond spread rose from 0.5% to 1.0% from 2002 to 2004, Aussie dollar-US dollar rose almost 50%, rising from 0.5000 to 0.7000. The same happened in 2007, when the bond differential rose from 1.0 to 2.50. Australian dollar-US dollar rose from 0.7 to just above 0.9. That's 2,000 fucking pips. Once the recession of 2008 came along, the major central banks started to cut their interest rates. Aussie dollar plunged from the 0.9 handle back down to 0.7. So what happened here? One factor is probably in play, as the traders are taking advantage of carry trades. When bond spreads were rising between the Aussie bonds and U.S. Treasuries, traders loaded up on their long Aussie dollar-US dollar positions. Why? To take advantage of the carry trade. However, once the Reserve Bank of Australia started cutting interest rates and bond spreads began to tighten, traders reacted by unwinding their long Aussie dollar-US dollar positions as they were no longer as profitable. A quick recap. So far we discussed how difference rates in return can serve as indicators of currency price movement. As the bond spread or interest rate differential between two economies increases, the currency with a higher bond yield or interest rate generally appreciates against the other. Much like bonds, fixed income securities are investments that offer a fixed payment at irregular time intervals. Economies that offer higher returns on their fixed income securities should attract more investments, right? Then we would make their local currency more attractive than those currencies offering lower returns on the fixed income market. For instance, let's consider gilts and Euribors. We're talking about the UK bonds and the European securities here. If Euribors are offering a lower interest rate compared to the gilts, investors would be discouraged from putting their money in Eurozone's fixed income market and would rather place their money in higher yielding assets. Because of that, Euro could weaken against other currencies, particularly the British pound. This phenomenon applies to virtually any fixed income market for any currency. You can compare the yields on the fixed income securities of Brazil to the fixed income market of Russia and use the differentials to predict the behavior of the real and the ruble. Or you can look at the fixed income yields of Irish securities in comparison to those in Korea. Well, you get the picture. If you want to try your hand at these correlations, data on government and corporate bonds can be found on two websites, Bloomberg and Bonds Online. You can also check out government websites of a particular country to find out the current bond yields. Those are pretty accurate. They are the government. You can trust them. In fact, most countries offer bonds, but you might want to stick to those with currencies are part of the majors. Here are some popular bonds from around the globe and their cool nicknames. Some countries also offer bonds with varying terms to maturity. You should make sure you are comparing bonds with the same term, such as a 5-year gilt to a 5-year Euribors. Otherwise, your analysis would be off. And we wouldn't want that, would we?